Okay. Okay. Now, I want us to continue our. Are you ready?
Yeah, I'm ready.
Cool. So, I want us to continue our discussion concerning the cost of capital. Right?
Yeah.
We have discussed um, debt, and we are currently discussing the cost of equity side of cost of capital. And we have established that we have like three methods to calculate it, which is capping, the dividend model,
Mm-hmm.
Miller and Modigliani. So
Mm-hmm.
we've done something on capping, and so I
Mm-hmm.
want us to move to dividend model right now. Okay.
Okay, dividend model.
Now, good. Now,
Okay.
using dividend model for KE. Now, we have two classes. Now, you have to determine whether dividend is constant. If dividend is constant or dividend is growing
Okay.
before you can that now when you are using dividend to make your KE, you have to first of all tell whether okay, is dividend constant or is dividend um, is growing. Okay, if dividend is
Okay.
constant or if dividend is growing. Now, the formula are not the same. If the dividend is constant, KE would be equal to dividend of year zero divided by market price X div. Dividend of year zero divided by market price X div. If dividend is growing, KE will be equal to dividend of year zero, 1 times 1 plus growth rate divided by market price X div plus growth rates. Or it's like this, dividend of year one
Mm-hmm.
divided by market price X div plus growth rates. Now, I will come back to growing dividend later. Let's talk about constant uh, dividend. So this is how constant dividend works. This is just it. Like if dividend is constant, you are doing dividend of year zero divided by. Now, you are saying that dividend of year zero is actually, we are referring to right now, current dividend, whatever the dividend is presently, or maybe the last time they paid dividend. All right. So next dividend will still be the same dividend as the current or as the last dividend. That is so if the last time dividend was paid, maybe 5 naira per share. If they are going to pay dividend next year and it's still 5 naira per share, that means dividend is going to be constant. Now, we are that is dividend is going to be constant. Now, but before I move on, I want to write another formula because I want I want you to go back to ratio analysis in CR, some interpretation of ratios, some formulas, investors ratio, profitability, liquidity ratios. Just go back to those ratios a little bit and do a bit of revision on it. It's going to be helpful.
Okay.
Now, I want to write some ratio. There's something they call dividend yield. Dividend yield is equal to dividend of year zero, which is current dividend, divided by market price, X div. Can you see X div? So you can see this formula this formula is not different from this one. You can see it's the same thing. Now, good. Please, I want you to take note of the difference. The difference is that this KE, the dividend of this KE, the DO in this KE formula, it is future dividend. Okay? It is not present dividend, it is future dividend. We just put it there as the dividend of year zero. That is, whatever dividend is right now, that is what dividend is going to be in the future. That is, we are actually talking about future dividend. But in my dividend yield formula, this DO, we are actually talking about present dividend, current dividend. So that's just the difference in the form. Yeah, they look the same, but for the KE, we are looking at future dividend. For this one, we are actually looking at present dividend. There's another one called earnings yield. Earnings yield, which is EPS or EPS of year zero or earnings. This DO2 is also DPS, so it can also be dividend per share divided by market price X div. That is our earnings yield times 100. So that is our earnings yield. Please, I want you to do a bit of research and get more of this formula of this ratio. Okay, let us move on. Now,